Hi, everybody. My name is Leo Cheng. I am a co-founder at Cream Finance, and happy to be here. Thanks for having me.
Hello and welcome to Reimagine 2021. This is our ninth conference in a monthly series of events, bringing you nothing but the best projects, bright minds, and leaders in the space. We've been very fortunate enough to invite many talented individuals and teams to come speak with us, providing updates, insights, and all the above that's happening in crypto. I'll be your host today, Adam, from the MouseBelt team, where we focus on early stage investments to our accelerator or providing development support to a number of growing projects, as well as education within our MouseBelt University program. Our main objective and goals are pretty straightforward. It's increasing adoption, use cases, and real world applications. We basically seek to educate our audience, everybody tuned in here, on blockchain by helping them understand crypto's real impact. So again, thank you all for tuning in at this moment. We've been doing this for a year now. We've been super excited. So glad to have you back. And without further ado, I have Leo Cheng, co-founder of Cream Finance. How you doing, Leo? Appreciate you joining the conference. How you doing?
Good. I'm good. Thanks for having me.
Awesome. So where are you calling from, actually?
I am calling from Taipei, Taiwan.
Nice. And I've heard you before. It's kind of cool. What's the scene out there, the crypto scene? You were here in San Francisco. We just chatted about it. It's kind of died down here. You probably thought you were going to miss out, but what I've heard is it's kind of cracking out there.
Yeah, definitely. San Francisco is very exciting, of course, and was a good place to get started. And I moved out here because, in short, I was spending a lot of time with lawyers, time and money, because some of the compliance overhead
Terrible.
that's required. Like, yeah, it'd be good if he's, that's, I think it's getting fixed, right? That directionally, I think it's going well. It's just at the time, my business partner was out here in Taipei anyway, and it made sense to just come out here. But definitely, Taiwan's been great. Good people, friendly people. There's a good group of crypto people, folks here, and they did just recently leave for various places, Miami, Puerto Rico, etc., for various reasons. And COVID's unfortunately picked up a little bit here. So we're kind of going into more of a lockdown situation, but all is well.
Awesome. And real quick, everybody has kind of a cool journey, right? We have a lot of viewers right now, ranging from university students, investors, right? Blockchain enthusiasts, crypto lovers, all the above. We have content for everybody, and that's kind of our goal with these videos. Is like, you've been working on things, we've been working on things, and it's it hasn't really reached the masses, and we're trying to get this broader reach with the content. And everybody has their own rabbit hole journey. How did you actually get into crypto?
Yeah, so I was actually kind of a San Francisco story. So all my career, and I've been in technology on the management side of technology. After graduating from Cal, go Bears, and so I was in hardware first, and then I went through a few different places: Apple, American Express, etc. And then eventually, San Francisco story. I was at Burning Man, met some cool friends, and then eventually, this whole startup happened where we did cloud computing, and we served Coinbase in 2014. So I learned about Bitcoins then, but I wasn't really involved in the industry. So it wasn't really until about 2017 or so I got super excited, and the company that we Solano Labs were at got acquired by General Electric, which gave us a chance to gave me a chance of a chance to focus more on blockchain, which has been great. So started out looking at things, did a little bit of consulting, helping out some projects, and then then we launched this thing back in 2019 where we tokenized music copyrights, and it was during the bear market, and NFT, early to NFT, but it wasn't really all that successful then. And then we pivoted that group Machi X into a DAO, which still exists today, and we did some NFT art stuff. But in the meantime, we were building at things in DeFi last summer, and looking at some of the unmet needs of yield farmers and degens, and that's kind of how Cream got started.
Nice. So you were ahead of the NFT game. And then now it came around. Our last event actually was NFT themed last month. So we invited everybody and kind of, with the NFT boom, DeFi summer, we had What the Fi is DeFi last summer, right? And that went pretty well, had all the teams. So what's cool is that you were a player in the ecosystem. And I've heard you talk about this too, like, and you just mentioned it. So what were you doing that gave you inspiration to create Cream?
Yeah, it was because I was actually degen farming myself,
Yeah.
and my friends, a group of investor friends that I farm with, and then we're like, "Yo, did you see this thing? Did you see that?" And then my business partner, co-founder, and friend Jeffrey Huang, we were playing with some things, and he was big in the Wi-Fi early on. At some point, he owned a fairly significant percentage of Wi-Fi tokens. He said, "You know what? This is really cool. Have you looked at this?" I'm like, "Yeah, I've been playing with this thing as well." And it's like, "All right, cool. What else do we need?" And then other farms started happening. Other farms started happening. And it's like, "Hey, how come?" And then I started thinking from a product need standpoint, why isn't there a way for me to, like, why is it that at that time anyway, lending markets only allowed like 6 tokens? Why is that? Why can't it be like the 3 4 major stable coins, ETH, Bitcoin, and like a bunch more stuff that people need?
Yeah.
So the farming happened, and then it's like, well, I could use other governance tokens like comp token. I could use YFI. I could use the yearn, the curve yearn LP token to farm yams and farm sushi and farm all that other stuff. Why isn't this stuff available? So then we thought, hey, you know what? We're really big fans of Compound anyway. We want to take that code and apply it toward this exact long tail of tokens that the market wasn't being served. So we thought, hey, look, this is something I would want. So why don't we build the thing and see if it works? And we did. And it kind of just kept going like, okay, well, if and then Yearn, dropped this YE thing, like cool, like it's like the best ETH ever. It grows on its own, right? So you should have that. Okay, well then there's this YYCRV, which later became YUSD. Okay, so now I have the best stablecoin that grows, and I got the best ETH that grows. Why do I even want the underlying thing when I could just hold on to the thing that grows? So then I thought, well, but then you have to unwrap one thing to get to the other thing. Why don't I create an exchange that allows you to go from the most yielding stablecoin to the most yielding Ethereum token and the most yielding anything else? And then you never have to unwrap, spend the time and gas, etc. So it was really, initially the thought was, how do we better serve capital efficiency? We just didn't have that term. So now our kind of official tagline is about we're a decentralized lending protocol. We're enabling individual and institutional access to financial services. And a lot of this is due to our part as the lending arm of the Yearn finance ecosystem. And we're focusing on the lending side, permissionless as well as protocol agnostic. So I think part of the theme here is the chain thing. So we're not exactly saying we have to be on one chain or another chain. And our main breakthrough here so far, still a big differentiator, other than addressing the long tail of assets, we also do protocol to protocol lending, which is part of this Iron Bank product that we can dig into if you like.
And what excites you about kind of DeFi? Is it the decentralization? Is it yielding? Is it technology, innovation, all the above, right? Because you have you have a background, and you were playing the game, and you saw some. What excited you? Like, was it actually maybe building something cool, like to make an impact for others, or was it like, oh, I can make money, or
It's both, definitely. I think I would be lying if I'm like money completely doesn't matter and I'm fully here for the tech. No, I am here for the tech. I'm a tech nerd. Like I love to learn about this stuff. And I think thinking back about my life, like when I started my career at Applied Materials, which is like semiconductor equipment, and it has nothing to do with blockchain today. I mean, I guess you could trace the supply chain, or whatever. But the fact is, I was never a material science guy. I was never an engineer, but I was always very curious. Like, yeah, cool, but I'm a bean counter. I do finance there when I first started my career. But it's like, but what does the thing actually do? What does the technology? Can you help me understand this? And I was super excited when I had a chance to take a class on semiconductor manufacturing process. So much in the same way, when I got to cloud computing, and I just had to get like a AWS certification on cloud architectures, just so I can prove to myself, yeah, I know how these pieces fit together. So I nerd out on a technology.
Yeah.
And so the same thing here. Look, you got a way that's like the future of money. We've digitized all the things, right? I think when you think back to history, the fact that the internet, you weren't allowed to have commerce on it until 1997. Like, what? Like, why would you have the internet if you can't like transmit value? And then you think, that's cool, but what about the idea of having the ability to transfer value natively? And why doesn't that exist back then? So now that it exists, I'm like, yo, dude, this is the thing. So not only is it exciting in technology, but it's also lucrative. And now we found a new way for people globally to access money and move money around and get that yield that they need, especially in an environment like this where the system is a bit broken.
What are some of the advantages of like decentralization?
So I think in terms of DeFi and then calling it decentralized finance, I always thought it's kind of a misnomer. It's more like an open finance thing. So if you really, really, really dug deep into the tech, it's like open finance is probably the best thing here. So the advantage here is that anybody can get into this, right? And that's like, to take a very extreme example, you just have some guy in rural somewhere, third country, with an internet connection, and someone enabled by sending this person first, like say call it $100 worth of crypto. That person can be an entrepreneur, much in the same vein that that person can go to study MIT course, open courseware, learn how to code. That person has accessibility. Now that's kind of fortunes at the bottom of the pyramid. It's kind of like in some ways, I don't know how much of that is the real case, but in terms of the real world now, every average user doesn't have to go to the bank, doesn't have to fill out a bunch of forms, doesn't have to feel like they're being discriminated. Like there's no way that our protocol sees you as a person, male, female, religion, creed, all the protected categories. None of that matters because you're just a 0x whatever, right? That's it. So it removes the need and the overhead of a bunch of the paper processes we have today, and it definitely removes any biases that the system may have against certain people. So it opens up access for everybody, and that's a lot of the kind of idealistic pieces. But now let's get down to the bucks. You can get huge returns. I was a bit disappointed, like, woohoo, my USDP yearn curve on my stablecoin basis went down to 15, 18%. Like, oh, woe is me. Now it's back up to like 45%. It's like, I tell my friends this stuff, and like, I feel I'm having more of these conversations. Like, yeah, so 45%. And they're like, how is that not a scam? I'm like, look, okay, we can go through all the steps. We won't do it here, but trust me, I have put my own money in there. Let's just say that. And then we're talking about security and how to kind of make sure you don't get, messed up on that. Of course, you should always ape responsibly. Just want to put that in there.
No, yeah, totally. I know people hear that, like even at the lower ends, that you're just kind of, parking it. You're in the double digits, and I'm telling my folks, and it's sometimes the ones that I'm looking at are risk free, but depends on what site you're looking at and blah blah blah. All that. But I also want to get into, because you're talking about a bunch of stuff, and we have viewers here that maybe not have heard of you or heard of Cream, or maybe they have. Yeah. I kind of want to talk, probably just go down this list real quick of sure, what products and solutions that you're offering, right? Just to kind of paint a picture and let people know what Cream is. So you guys provide lending, borrowing, swap, payment, tokenization of like services, right, for digital assets. So let's maybe go down. Like, let's talk about lending. Talk about kind of the lending side of Cream, and how's it operating? How does it work?
Yeah, so the swap thing we've deprecated since our merger into the Yearn ecosystem, and we moved all of that stuff to our friends at Sushi Swap. So we don't compete with our ecosystem partners in that sense. So the swap is no longer there, but our main focus is on lending now, and we have done. We recently launched a validator service that's pretty exciting, but again, that later. So the main focus is lending for now. And it basically, if you are a very, very noob user and you're like, hey, I bought the dip, right? I bought ETH at 2,500, like, yay, good for you. Yeah. I have like, some amount of ETH or some amount of, BNB or Phantom, doesn't really matter. We're currently deployed on all three chains. And so what you can do as a user, very simply, is kind of use it like a savings account. So you could just deposit the tokens in. And it's a peer-to-peer lending. You're borrowing and you're supplying against a pool. So
this is kind of like the what was it? Lending tree.
Yeah, it is kind of like that. Yeah. You put money in, and then you have, based on other people borrowing demand, they pay you. Yeah. They pay the pool, and you get paid from the pool, and then the intermediary in the middle takes some of the money. In this case, the protocol keeps some of the fees. I do have to mention that we initially forked Compound code, and we very luckily have them as good friends. That as a security technical advisor, we gave them some more tokens. I mean, there's a whole other story behind that, but let's stick with the product side. So if let's say I have some amount of, let's go back to $100 again. I have $100 of BNB, or if I have $100 of whatever tokens, I stick that token into the pool, and I'm getting some amount of interest rate. And then, say you come in and you're like, I have that need for Leo's BNB, or it's not specifically mine. You just need some BNB, and I may have some percentage of the granted pool. So you're borrowing from the pool itself. And the beauty of the system, as opposed to like an order book system, is that the instant you put your money in, your tokens in, you're earning interest from the underlying itself. So if you put BNB in, you earn BNB. You put Ethereum in, you put Ether in, you earn Ether. You put wrapped Bitcoin in, you earn wrapped Bitcoin. So the percentage yield you're seeing, most people are used to thinking US dollar yield. It's not a US dollar yield, which means, of course, that the tokens underlying go up. You earn more of the tokens, so therefore the US dollar values go up. So this is also, we have to think in terms of the underlying currency. And so, but it's over collateralized though, kind of like a home loan. If you have you know, $300,000 for a home equity value, not in the Bay Area, but and you can borrow, you know, home equity like not over 300,000 because you have to be over collateralized in case the value goes down and they have to sell your collateral for some reason. Then they have to cover. So same thing happens in this lending market because of the volatility and solvency of the system.
How do you? What's the mechanism to earn ETH? I put in ETH. Where does that ETH get generated from? Oh,
right,
the margin on the lend on the
you don't even have to that's the first step, right? So let's say I put in, you put in 1 ETH and I come in and I'm like for whatever reason I want to borrow ETH, but let's say I'm bearish. So like, you know what, this whole thing is a scam. It's going down. Vitalik, I heard he's like not working there anymore or something. Like if you come up with some FUD and then you go, okay, you got 1 ETH and let's call it $3,000 right now. And let's say I've got, I put $6,000 in. So I'm 50% over collateral, 100% over collateralized, or I'm using 50% of my collateral to borrow your 1 ETH. So a few things happen here. It's an algorithmic lending model. So that means that I've taken from nobody using it, assuming just you and me in the market, nobody else. So assume that there's there's zero utilization and then max utilization all of a sudden. So the interest rates adjusted based on how much of it's used. If I borrow half of ETH first, then I would have an interest rate that's half of that. So let's call it roughly, you know, 10% interest rate. And if I borrow all of it, I might be paying 30% interest rate into the pool, right? So under that event, let's say I did borrow all of it. I'm at max, it's a little bit over 30%. So let's say it's 30% interest rate. Then that 1 ETH a year later, I would have to come back with 1.3 to get my $6,000 of collateral back, assuming, of course, the underlying value don't change. And then when you withdraw, you get 1.32 ETH, and who paid for that 0.32 would be me, because I borrowed it and that was my car. And if for whatever reason it is, ETH went up in this 1 year, and I put like stable coins as my collateral, then somebody out there can permissionlessly liquidate my token by paying back my $3,000 of collateral and then paying back that ETH into the pool. Yeah. So the unknown third person, we don't know who it is. It could be a bot, could be a human, doesn't really matter. Yeah. Like here's this person, nobody knows who he or she is or they, and then you got your money back because this person like liquidated Leo's loan because you know the value was there. So it's a pretty cool system. But so that's just like that actually illustrated a few things. If you're just a new person in the field and you're like, I got some ETH, I want to get ETH yield. Okay, cool. So you do that, you get your ETH yield. The next thing too that illustrated me as a user is now I want to do a position where I am leveraging short, right? So I could take that ETH I got from you, I could sell it for more USDC. Now I got $3,000 USDC. It deposited back in. Now my deposit position went from 6,000 to 9,000, but I only really own 6,000. And then I could borrow more ETH if there was more in the pool and then sell that and then so on and so forth. And I'm borrowing at this 30%, 32% max rate, which is a lot cheaper than leveraging on exchanges, which can cost like, they calculate their rates at like every 8-hour chunks, right? So it could be like 0.2% or 0.08% or something like that per 8 hours. So it's and how do you get Cream tokens? You guys have your own government? Do you have your own token as well? Yeah. So the Cream token for now is used as governance for voting into approvals of policies as well as token selection. So one thing we're moving toward, though, we're revising our tokenomics, and we're also bringing in a token listing team. So for now, the main feature is to have the governance by the token holders. So what we're moving toward now is a token listing committee of really smart people with a lot of knowledge in the system, because much the same as in at least most economies, you don't have, you know, individuals, like you don't have Americans voting on the Federal Reserve policies. Like that's probably a bad idea.
I've been thinking about that. I'm sure we all have, kind of like we just moved away from that, and that's how our traditional economy ended up with our smart, you know, whoever got chosen. And then I feel like crypto brought back, let's give it to the people. And like, I don't think it always works. So I'm excited to
That's
kind of
interesting.
hear. I'm excited to hear because as this thing scales, it's like who's voting, and then you hear the other governance models of like, or even on the staking side, like delegated, you're delegating your votes, but then you're becoming more centralized, that whole theory of you're giving more to the rich, blah, blah, blah. But no, I'm sorry, I didn't mean to cut you off, but
No problem.
I thought about that. And it seems like you're going towards that way to say, hey, I
We
think
can
we
talk
need to
about
like,
that. Yeah.
scale this back in a little bit to some qualified, individuals.
So a bit to finish off the tokenomic bits. Basically, the tokenomics, the token holders control the fate of the treasury, the direction of the protocol, etc. We are working on this idea called ice cream, which is basically it's a combination of the XSushi model, where the protocol fees will be used to will be collected, and then tokens will be given out to stakers who stake the model. So if you're actually putting your tokens down, making decisions, helping out, driving the protocol, then you deserve to get paid for doing that work. And then also, the other side of it is we're relaunching liquidity mining. So we started the summer with liquidity mining last summer. And we eventually, the kind of DeFi summer ended, we turned it off because it was like, well, look, people were just farming and dumping the token. And basically anybody who bought, believed, and governed the system was getting fleeced by the people who don't, and they just farm, take the token, dump it, etc. Which is why I think lockups are important. Curve demonstrated that, Sushi demonstrated that. So we're following these patterns that work. So that's why our new ice cream model is going to be basically a merge between the XSushi and the VE curve model. I know this is getting a bit more of the advanced stuff that people.
That's all good.
Let's go back. But let's go back to the governance piece. Here's my thought. In before, I mean, if you go back to more earlier history, the reason that like polling booths are closed on polling day in America, from what I learned, that's open for one day. It's like sometimes in the rural countries, it takes you like a day to travel to and fro from the voting booth on foot on your horse, right? Well, that's these days Americans can't be bothered to cross the street to vote. Like, forget it. Like, but anyway, that's another topic. But so when you think about it, it's about like access, right? It's about and you vote, and if these people are in their terms for 2 years, 4 years, whatever. Again, like you can't have your whole people base like travel for a day to vote, and if you're going to do this every 7 days, like how is that even possible? I can't. And fast forward to now, we have this internet, we have this ability to authenticate through cryptography, we have this ability to vote every 7 days or 2 years or 4 years, whatever you want, and you can vote to change that. So from the standpoint of a listing committee, now we have very smart, educated people who understand valuation metrics, who understand safety, who understand like liquidity depth, etc. And these people are nominated and voted in by the token holders to make these decisions. Now, unlike our existing political system globally that's democratically elected, these people can actually be voted off kind of whenever, right? So let's say, for example, this voting committee example, we're bringing in some pretty sharp people, and we're about to put on the nomination for approval for the token holders. And someday, let's say you're a big token holder, and you're like, you know what, these guys are dumb. Like, I don't think they're doing a good job. You can put up a proposal to vote them off, and you say, yep, that's it. We're good. So it would be the same as, like, when you think about an impeachment process, that takes, like, that's a huge undertaking. It's a huge distraction. It takes a long time. There are a lot of processes in the token governance model. That doesn't have to be.
Mm-hmm. Yeah. Why wait?
Yeah.
And why is there a token committee? You didn't have one before. And is it now because it's a little more mature? Are there more tokens, less tokens, complicated tokens, or is it just time to say, like, this is the next step to make sure, manage risk? And
it's a little bit of both, like decentralization as we push toward that. And that's kind of my original first point, right? If you're saying we're a decentralized protocol, well, is it completely decentralized? No, it's not. But we're moving toward that. That's why I like open finance better than decentralized finance, because, from a product standpoint, you can start very, very, very super decentralized, which would look more like Aragon in a DAO space. It's super, super decentralized. Everything's smart contract based. Awesome, awesome, awesome. But the thing that's being used in governance right now is like snapshot vote and stuff that's just an off-chain gas list. Like, here's a thing, here's a signaling, right?
Yeah.
So how much of it can't be completely decentralized if it's signaling only. It's completely decentralized. Everything's on chain, but there's that happy medium in between where you got to balance out usability, the effort to build it, etc. So So when we get toward this token model of the committee, is because we're moving toward decentralization. Where initially it was like, okay, cool, we have this thing, we have a token system, so the token voting via snapshot decides everything, including policies, including listings, including reserve factors, including collateral ratio, et cetera, or collateral ratio is roughly like the credit line. So we're moving toward that forward. Also for scalability, because we find that we're not moving as fast as we need. So back to the fact that we're serving the long tail assets, we have to continually evolve our product and our governance system toward that. So the governance system with the committee, then there's a better, clear, independent party that says, okay, what this is, what can be, it shouldn't be. Maybe here are the policies. And in addition to that, as we address the long tail, we also have come up with some new security measures outside of security coverage we've done on bug bounties, audits, etc. We also have developed our own security features that can help us guard against this special usage of long tail assets. The compound doesn't have, but they also don't need, because their assets are a lot more major with deeper liquidity, etc.
And how many tokens are on the platform now?
Oh, geez. I think I lost count, frankly. It's like, no. We're over 60 tokens listed right now. Yeah. And then so it's just not just one platform. So we're on Binance Smart Chain. We're on Ethereum twice with the Iron Bank, and also the one on app.cream.finance. And then we're also on Phantom. So the combination of those things, if we counted each thing and we kind of double, triple counted tokens that exist in all three places, then I actually haven't done that math. It's probably closer to 80.
And how does that work? Like, did you have to create a standard? Like, how is the onboarding process? Do they each, for those protocols, have their own standards that you guys just integrated? So kind of like ERC20, right? Like, you could have all ERC20s, and then you could have all, Binance Smart Chain tokens.
Yeah. The BEP20 tokens on Binance Smart Chain, and Phantom's equivalents of the ERC20, same thing. So if you have a standard way to tokenize these tokens, which actually then makes things easier to evaluate. And so we then take a look at the standards there, and if they abide by the standard, there's no weird stuff going on in the tokens. And we also looked at things like Ampleforth, and we're working with them as well right now to see about adding tokens like Ampleforth that rebase. And that excuse me, that one's not a standard ERC20, so it throws a little bit of a wrench in the system. But when we do our CR token, which is your collateral token that you receive when you deposit something, we have workarounds for that. So not all of our tokens are the same. For example, native tokens don't work the same as ERC20. So Ether doesn't work the same as a wrap Ether, for example. So there are different ways of handling those things. But roughly, those are more technical hurdles, and we also really need to consider how concentrated or focused it is, and how much liquidity depth there is on decentralized exchanges. Because when it comes time to liquidate, you got to make sure that you can do it quickly. So ideally, if you can go do a flash loan to do it in one instance, that's safer. Because if you have a massive spike down, like what happened in March and what happened recently, in order to make sure these protocols are solvent, you have to make sure that liquidation processes can happen quickly and aggressively. And so as demonstrated in this last round of pullback, the DeFi lending protocols have all fared very well with the volatility. And I think that's fantastic. And that's a huge growth metric for the industry.
And we've kind of talked about providing collateral and lending. On the borrowing side, I've heard you talk about credit worthiness, and we are having to over collateralize. Are you working on this kind of this new credit system where you don't have to over collateralize?
Yeah, so we already launched this idea of the Iron Bank, right? So it is a protocol-to-protocol lending product that it was our first collaboration with Yearn. So I thought I'd put this background on this, and consistent with the theme, and then the Iron Bank logo here. So the Iron Bank is basically a separate market on Ethereum. So on Ethereum, like I said earlier, we have two markets. One is on yearn.fi/lend, and that one is the Iron Bank itself. And then we have another market on app.cream.finance, and that one is our long tail asset. So you can also think of it as two tranches at two different pools. So the Iron Bank one is known quantities, DeFi blue chips. And then on app.cream.finance, it's a bit like riskier assets, longer tail assets. And we do put provisions in there to ensure that there's a certain lock on how many tokens can be used as collateral through our collateral cap product. But the Iron Bank, focusing on that for now, is a protocol-to-protocol lending system that enables whitelisted protocols to tap the liquidity from in the Iron Bank without a collateral. So this innovation is actually really cool. As far as we know, we're the only ones doing right now. And so it could be under collateralized, it could be uncollateralized. So I'll give you two examples. So our partners right now, mainly using our Iron Bank, are Alpha Homora from Alpha Finance and the Urn Vaults. So from the standpoint of Alpha Homora, it's the idea that users can go in there and then maybe you could put ETH in, and then you can leverage your farming of any pair you want, ETH Uni, something, ETH Sushi, etc. And then you could then, or ETH USDC. And then what you can do is you say, okay, I want to make money on the trading fees, let's call it. And instead of having one ETH in and then one ETH equivalent of the stable coins or whatever the other side of the pair is, you could put one ETH in and the equivalents or 2 ETH worth or whatever. And then you can double up or triple up or leverage based on that. But from that standpoint, it's still collateralized because you have your initial deposit in with Alpha Homora. Then Alpha Homora borrows from the Iron Bank to give you the rest of that leverage. But if you fall below the certain coverage area, then they will start liquidating you. So from the perspective of the Iron Bank, it's uncollateralized because it's not on our smart contracts, but it's actually collateralized on Alpha Homora's contract. So it's uncollateralized from this perspective, but collateralized from their perspective, meaning if they get liquidated, the supplier gets liquidated in Alpha Homora, the money does flow back in the Iron Bank. So it's uncollateralized directly on our protocol, but it's collateralized on theirs. So, but that actually just basically means that it also utilizes one of the benefits of DeFi, which is that partnerships can occur without actually talking to anybody. There's no more need of like, hey man, do you know Leo? Can we talk about this? No. Just use our contracts and go. And then the other side of it,
is that kind of relating to composability, like money Legos?
Yes,
is that what you're talking about?
Yeah, exactly. So when you think about a flash loan, right? When you do a flash loan, you might borrow from our flash loan in Iron Bank. You might go repay something on Aave, or you may repay something on our app.cream.finance. But in between, you might be taking your money to SushiSwap, Uniswap, 1inch, whatever, and then you repay the thing. You go back to AMM and then repay the loan back on a flash loan on one same block. In this case, it's not like you have to go sign into all these protocols, because in the Web2 world or in traditional banking space, you got to talk to some person over there, get your credentials, log back in, and then log back, blah, blah, blah. And then it can't get done in 15 seconds. At least there's that. So anyway, so in case of the Urn vaults, the borrowing is actually not collateralized. So it's not just under collateralized, it's uncollateralized at all. So the first iteration of the Urn Vault for DAI, for example, they deposit one DAI in the compound, and then they borrow some of the DAI, and then they redeposit and they borrow, and then they get this yield from the lending, as well as they get the yield from the comp tokens, and then the automation harvests the compound token for yield, and you end up with more DAI. So in that system, one DAI goes in, one DAI starts. But if you can borrow from the Iron Bank, so example, one DAI goes in and they borrow 0.9 DAI from the Iron Bank, so as an example. And then at that point, now you start with 1.9 instead of 1. So you can imagine your yield is juiced because you have this additional piece of liquidity coming in. And in the event of any failure, then that $1 you put in is more like the equity, and that 0.9 you borrow from us is like a senior debt. So if anything goes wrong and Urn doesn't pay, although historically they've never had that happen, but let's say in that situation it happens, then you're the equity. That loss comes out of you, and the 0.9 still goes back to Iron Bank because we're senior debt. So all this is about capital efficiency, right? We don't want to have money sitting around doing nothing. We want to put money to work and increase that kind of flywheel effect of finance.
And how do you incentivize people to, become LP miners or provide liquidity? What drives traffic to say, I want to give up? And you mentioned it, like, I think a lot of it's education. Like you said, do you want, you're sitting on some crypto and doing nothing, I'm assuming that's kind of the incentive. But what do we need? Like more marketing or these numbers are crazy still. So it's kind of like, I don't know. We're in this bubble, you're talking about all these TVLs of, hundreds of millions and billions. And so like something's going right, but we still haven't even tapped everywhere else. So like, how do we, how do we get more people to, and everything you saying, how's the UI UX too of everything you're just talking about, the moving around, the depositing, like from Cream's perspective, like how's the UI UX, and then how do you get people to continue to deposit or attract new, because it's fierce competition in the space.
Yeah. So we are looking at dialing back up our liquidity mining program. And when you think about it, we are the only lender in the system. Well, I mean, Maker doesn't, I guess. When I think about Compound and Aave, they both have a liquidity incentive program. So we don't, not right now. We did, but even without it, we have
Yeah.
like $1.4 billion to deposit. And we have, with that $1.4 billion of deposit, we have 650 million or so lend out. And so
Wow.
that's close to almost 50% utilization rate, which is the highest in the industry. And that's across Iron Bank, our main Ethereum market, BSC, and Phantom. And so where our usefulness comes in is actually capital efficiency. You put your money at the Iron Bank because you're going to get good yield. And also, you're going to get good usage out of it. So we allow a fairly aggressive kind of credit line, if you will, of collateral factors. So for the same dollar of Ethereum you put on our network, on our system, you can borrow more money out of it than you can, say, at Compound or Aave. And so, or even Maker for that matter. So if you want to put your Ether in, you want to be long Ether, you want to borrow stable coins to buy more. To buy more of Ether to leverage long,
Double
um,
down.
you can do that. You could do that safely on our platform for a much lower cost. That's actually a strategy that, and you should be really safe. Just to actually, yeah, I think we want people to be safe. Just because you have 100% of your credit line, like you don't want to use 100% of credit line. Like you should. What I do personally is I use about 50% of my credit line. So you can have like a 50% drawdown. You're like, oh, I might get liquidated. But if you're like using it up to like 95%, the market only needs to drop like 95%, and then all of a
That
sudden
happens
you're
every
like,
like 60, 90 seconds.
yes, exactly. Yeah. So that's a challenge there. But besides that, back to what you're saying about the UI, I think it's great that Aave and Compound has trailblazed this and have a bunch of credibility, so that now you can. I use applications like ZenGo, and actually, I guess that's a smaller one that people. But I like it because of the security features. But I mean, I'm not here to talk about wallets, but like wallet apps that people could put money into that could fiat on ramp. That's the holy grail right there. So I'm talking. We're also talking to a few different applications that are allowing people, like I think Dharma is a good example in the US people could use, where you could put money from your ACH, from your bank account, Wells Fargo, B of A, whatever, and you could drop them right into Yearn vaults. You could drop them right into Compound markets. So when you think about, oh yeah, my Marcus or my whatever traditional like banking savings account, they sent me this ad, I can get 0.5%. It's like, okay, well, how about you put that in the Yearn vaults, get yourself 45% on a USDP vault. Then, for like every 100 you put in, you could call that $100,000 worth of interest. Like,
Yeah,
that's
yeah,
crazy. That's crazy.
yeah. I know, I know. Um, so that's great. So the UI UX is what you're saying on your side is
Easier
pretty
to
pretty
use.
pretty friendly. Yeah, which those were some of the challenges and barriers that we've had experience and we kind of still do here and there. It seems like you guys have tackled that. Um, now, what about ETH2 staking? Do you have a service or some kind of option for your current users now?
Yeah, yeah. So we actually do have an ETH2 staking service, and this is part of what I was saying earlier in terms of like, as a degen, I want degen stuff, but in this case, it's less degen. It's more like I'm an ETH believer, and I did just about 8 months ago have a kid, and I was thinking like, hey, I would love to have her get like 32 ETH and have a node, and maybe pay for college or whatever in the future, which at this point looks like it's possible. But then I thought about how hard it is. Like, oh, well, then I have to go spin up this node. I have to do all this stuff. And it's like, I don't want to maintain it. What if it goes down? I get slashed. Like, I don't want to worry about any of that. It's like, okay. So I started looking around. So then it was like, well, once I put it in ETH2 staking, it's locked until ETH2 is open. And then what am I going to do with that liquidity? It's again not capital efficient. So then we decided, cool, then we'll just launch our own staking service, allow users to get like a proof token, the same way that when you put ETH in, you get the CR ETH token as a proof that you have this deposit. And then we said, okay, cool. So if users come in here, deposit their Ethereum onto our staking service, they get our CR ETH2 token. So it's a Cream ETH2 token. And now you can deposit that as collateral on Cream and borrow it against it like you do your current Ethereum tokens. So you're earning yield by lending it out, and you're earning yield by ETH2 because of staking. You're getting that proceeds, and you could borrow money against it if you wanted to, pay for personal expenses, buy some NFTs or pay for rent or whatever. And that's all. I think again the innovation of like what do people really need in the space than what we're building it. But from the E2 staking, we actually expanded into BNB and FTM staking. So we're now like number one, number two on the BSC validator space out of the 21 validators, and we've made a good amount of money. I mean, we launched this thing like 22 days ago or something like that, and we've made about $200,000 in BNB in fees already from validator nodes, and we're doing that for FTM. We're going to be doing that for all the chains we launch into, because it services the need of the DeFi user first and foremost, but it also adds to decentralization of the chains that we go to. So we don't see ourselves as the benefit we bring isn't just a DeFi player and lending protocol capital efficiency. It's also like, hey, what else do you need? So we're going to build this validator thing for the chains that we can, and then allow our users to do that, but also help our chain partners that we're on to decentralize. So, BSC gets a lot of crap sometimes from people like, oh, it's not decentralized, like CZ owns all the nodes. Well, I could tell you for sure he doesn't own this one node out of 21 at least, for sure, because we control that.
So when you spin up these nodes, are these funded by your community, or you put up? Is it delegated, or do you have to put up your own token for that for the chain?
Yeah. So the validator node system isn't as unified. So when I say like for lending markets, right? If you use our lending market on Iron Bank, on like a regular Ethereum V1, on BSC, on Phantom, that experience is pretty much the same. So you log in with MetaMask, or at least if you do it from the Web3 and not from like a wallet or something like that, and then it looks and feels the same across. You have your RPC selector on MetaMask, and it's good. But the thing about validator nodes is that not all chains do it the same way. So then the UI is not the same. It doesn't work the same. Some have certain lockups, some have variable lockups. And so therefore, it's really hard for us to unify that. We'd love to, but let me just walk. There's only 3 of them right now, so I can walk through. For ETH2, users can just go to app.cream.finance, and there's like a staking section. You can go there and do the ETH2 staking. You can send your ETH2 in, but right now, you can also just buy them off of SushiSwap. It's actually trading at a discount right now. So if you're going to be in for a long term, I think it's even as deep as like a 10 or 15% discount right now, because sometimes people go, oh, I want a FOMO and this other thing, give me my money. So that's actually one way to get ETH2 cheaply. But besides that, if you want to just deposit it in, you send it into our contract, and then we would send it to a staking service that we run, and then it goes into ETH2 staking. And then for BNB staking, you would just go into Binance.org staking page and then log in with your BNB wallet, and then it has to be BEP2 instead of BEP20. But if you are doing this, you kind of know what I'm talking about. And then you can just click the delegate button. It's pretty easy. On FTM, you got to go to their F wallet, which is their native staking interface, and then you find our validator, which is number 60, and then you could just delegate to it.
Nice. We got a few minutes here, and you brought up all these chains, and your background is showcasing the theme of this event, which is Game of Chains, Battle for the Throne. We came up with this concept because Bitcoin came out, Ethereum came out, and then all of these supposed, Ethereum killers and different. Everybody's trying to figure out, what works best. Are you a believer there's going to be many chains?
Yes. Yeah. Yes. I'm a believer of the multi-chain future. I'm a believer that it's going to be mostly layer 1, EVM compatible layer 1s, as well as layer 2s of Ethereum. So basically things are EVM compatible. And the reason that is when we look at deployment, we want to, of course, we need to look at security, and we need to look at like ecosystem. You don't want to be the only one at a party and there's nobody there and you're like, hey, so this is a part of the benefit of being a Yearn ecosystem. We talk to our friends at Sushi, the Yearn strategists, etc. So when we come to the party, we bring Yearn vaults with us. We bring we make sure we're working with some AMM when the ecosystem's there. But zooming out a bit, when we look at different chains here, I think that the future at a very high level is a multi-chain world where the barriers to switch is significantly lowered. So there are other complexity. Layer 2s have the 7-day lockup, whatever, and you got to bridge over layer 1s. And how do you do that? They're different, etc. But I think solutions are coming out where the barrier to switch is lower. What's going to happen there is actually serves a consumer better, because now you have different chains kind of competing for everybody's attention. And incentives are coming up, which is why I think DeFi Farming Summer 2 is happening soon. Because you have, so right now we're on Phantom Ethereum and Binance Smart Chain. We're deploying the Arbitrum now, that layer 2 that's now often talked about in the last week or so on Twitter. They have a fantastic technology. They're going to be the first optimistic roll-up technology that's deployed. And we're happy working with them. Things are going smoothly. After that, we're also looking at we're a bit late to Polygon, so we're also working on Polygon. We're working on Moonbeam for Polkadot ecosystem, which I think is going to be pretty big. And then other chains we're considering include Harmony, but in the future, roughly looks like a way to transit fast, and whichever chain has the best technology, best ecosystem, best payout wins the end user.
And when you say you're looking at Harmony and Moonbeam and some of these other, what does that entail when you say I'm going to build on Polygon, or I'm going to build on this? What do you guys have to do to do that? Is it a bridge, or you have to like start not from scratch, but you have to like rebuild it? What did that entail when you start looking at other chains and deploying on the chain?
Okay, yeah. So EVM compatibility here, for those who may not be familiar, so the Ethereum virtual machine is the underlying compute that runs this stuff. So our code that's mostly written in Solidity would just deploy into these environments that are able to support and run this code. That's the Ethereum virtual machine. To contrast this, we're a bit conflicted. We have a lot of respect for the Solana ecosystem. We think that FTX and Solana and those group out there are very capable people. We have no doubt that they're going to succeed, but I think that in the evaluation of chains, if we were to go there, we'd have to rewrite our application in Rust. Yeah. So it's not in Solidity, and that has additional overhead. So from a project standpoint, now I got to think about: do I want to deploy on, like, let's call it 2 or 3 of these chains, or do I want to go to only Solana? Now, our argument could be made that Solana is the only thing you're going to need in a year. Maybe maybe not. I don't know.
We don't know.
So yeah, we don't know. So, but outside of the technology bits, we also want to see and make sure that there's a few main things. One is you have to have users, right? You have to have users, you have to have assets, and you have to have a healthy ecosystem there. And our original thesis, we were going to launch first Cream on Binance Smart Chain, because we noticed that DeFi wasn't serving super large market caps like back then anyway, last summer, like XRP, Ripple, Litecoin, Bitcoin Cash, Cardano, Cosmos even aren't really that much into the ecosystem. And to me, is like, why would that make any sense? Like, if you added up the market cap of all these tokens, that's a huge untapped market. So we thought, okay, Binance Smart Chain, because they have this pegged asset thing, so that users can take their tokens and then send it to their BEP20 version, and allow then we have done that integration. So users can take their EOS, that they take these tokens that arguably some say they're good, no good, whatever. But I'm not here to make a judgment on what is good or not. I'm here to serve the needs of the users. Yeah. And users can then take these tokens on Binance Smart Chain and supply and borrow them just the way they can with USDC, with Ether, with Wrapped Bitcoin. Now, so that's why ecosystem, pegged assets, user, and transactions are interesting and useful. But I will have to say, though, that on the Binance Smart Chain markets, we've seen a lower amount of activity across these tokens that I talked about, given the size of the market cap. And it might just be, though, that a lot of the DeFi activity exists mainly across these tokens and chains that are more DeFi active, natively.
Yeah, sorry, and you're talking about the EVM side, like if they're as opposed to like your Cosmos and like
the assets. Yeah, I think that there are less people as a percentage of market cap. There's a lot less of that liquidity, running around in DeFi, in EOS, in Cardano, and XRP and Litecoin and Bitcoin Cash. Those community are less engaged in DeFi for whatever reason it is.
Yeah, it's kind of interesting. And a couple last 2 questions here. Like, do you have any data or some kind of update in the DeFi landscape? Actually, we're just talking about a little bit of it right now. Just the users and kind of the communities that are more DeFi active. Have you seen, since your guys' launch, I don't know, more TVL, more users, more, what are some numbers that maybe you can share to paint a picture of the activity that you see? And it can be whatever, more wallets, more this, that, and the other. Curious.
Yeah. So when we launched last summer, we were super excited to be like, OMG, 400 million, whatever. So now it's like, we've got $1.7 billion deposited, a little bit over that on our platform. And it's like, I mean, okay, so taking outside just in the main context of any startup, like, yeah, we're less than a year old and we've got $1.7 billion AUM. Like, who does that? So,
That's awesome.
right, on a team that's not
That's
like
crazy.
yeah, we don't have like floors of employees, like we don't have,
Yeah.
and that's the beauty of Web3, right? Like the smart contract ensures that everything runs and settles. There's no like, hey bud, I did this thing and there was a clerical error, can
Yeah,
I
yeah,
get a refund? Like that doesn't happen. And then I jokingly say, if the whole team were hit by a same bus and all died, the thing will still run, and that's the
yeah,
most incredible piece. So I think, as DeFi crossed over $100 billion, like a few weeks ago before this crash, I have no doubt that we're gonna hit like, we're in June right now, right? If you were talking about like prediction land, like 200-300 billion dollar TVL for DeFi by the end of the year, not surprising. Like a trillion, like, ooh, that would be surprising. I don't know if we're
yeah,
gonna hit a trillion by the end of the year. You never know. You never know. We could also go down to 10 billion dollars instead of 100. Like the market's so volatile.
yeah.
But yeah, in terms of numbers, like the growth is humongous, man. Like if
Yeah.
you think about how Compound, as the OG lending protocol for this model, they've been around since 2018. 2019 was kind of like crickets. It wasn't until really 2020 that it really blew up. So the industry has had such tremendous growth. And I think those are kind of roughly the numbers. Now, if you go scale out into a more of a macro lens, you're looking at like the $2 trillion crypto market versus something like a $300 trillion equities market. So there's still a lot of room to go.
Yeah, yeah. But sorry, one last question. Like, are you worried about Ethereum's like scaling and gas problems and all that, or do you think that would scale with scaling solutions helping Ethereum?
I think actually, Ethereum scaling solutions maybe this is a contrarian view. It may be over already. I mean, look at the gas prices right now. Yesterday, I voted on a proposal, one of my DAOs I'm in, for 15 Gwei. I have not seen that. 15.
Wow.
Um, and I think a lot of this could be due to miner extractive value going down with things like flash bots and Archer DAO MEV prevention, as well as the side chains like Polygon and like all these other ones going. And you could also even consider like BSC a side chain, right? So I don't know about you. A lot of my friends learning DeFi right now starting at BSC because it's cheaper.
Mm-hmm.
But either way, I think you got ETH2 coming around the corner. You've got the scaling solutions coming out next week with Arbitrum, and after that with Optimism. You've got Polygon continue to have a lot of users. I don't think scaling is a problem at all. In fact, I think what's going to happen is chains are going to have to start specializing, and then you're starting to see it happen, right? Polygon's actually doing both DeFi and NFTs, but
Yeah.
XDAI is kind of like the sidechain of choice right now for Moloch DAO and DAO Action going on over there. They have some NFT. They have a little bit less activity there in DeFi. So I think the future is going to hold where chains are going to specialize on certain things. So going back to Solana, they're super betting down on like exchange and trading of assets and value. And then BSC is basically the integration with the huge like exchange is going to lead to a lot more users from that side. So they're introducing. So it's like different chains are addressing different use cases, different demographics, different language regions of
Yeah.
people. And I think that's actually a very beautiful thing, because the whole idea for me here is proliferate DeFi and proliferate blockchain to reduce the friction, to make things more effective and efficient, whether it's capital efficiency or I'm a fan of NFTs, like the idea that you could digitize assets and not just art, right? So I'm talking about real estate. I'm talking about removing the need for an escrow middle person. Like when I bought my home in California before, I was like, hold on, I'm paying 10K for this dude to like hold my money and hold my deed and then swap. Like, isn't there a technology for this? And then, oh, the title insurance guy. No, this is called your transaction doesn't get confirmed because you don't have permission to move that NFT token that represents your home. And that's your lien. If it can
Yeah.
move, then there is no lien. So, I mean, I think overall, these chains and what they're going to do, it wouldn't surprise me if some chain is like the real estate chain that does this, like real assets transaction, and it then bridges in with DeFi. So now you're going into an OpenSea equivalent of a real estate market, and you're going to get your loan from the Iron Bank, and you're going to buy or sell that home, and one transaction, your collateralization is that the terms are there, your loan servicing, and then you can put up wrap Bitcoin for collateral or something like that. It's going to be a beautiful world.
Awesome. Awesome. No, I mean, yeah, I believe that too. There's going to be different chains for different reasons and different purposes. And Yeah, there's these other blockchains that are trying to, outdo Ethereum, and then there's Ethereum supporters. So it's just kind of interesting to hear everybody's take. Last question, Cream. For those of you who don't know, like, what does Cream stand for?
Crypto rules everything around me. Cream. Get your money.
And I'm
Dollar
assuming, I'm
bill, y'all.
assuming, I'm assuming you're a Wu-Tang fan, I guess, or
I
what?
am. I am definitely a
There
Wu
you
Tang
go.
fan. Yeah, I saw them at Coachella. That was cool. Also,
Yeah,
my co-founder, Jeff Huang. He's a kind of a hip hop star himself here in Taiwan. He brought hip hop to Taiwan, and we're fans of hip hop, and just like cash rules everything around me. But that was so like, a few decades ago. That was so like before the turn of the century. Like we need this thing to be about crypto rules everything around me. Cream.
I like it. I like it. I like it. Well, we're coming up on time here. Leo, again, thanks for joining us, participating. Everybody watching, just talked to Leo Cheng, co-founder of Cream Finance. It's a decentralized peer-to-peer DeFi platform providing lending, borrowing of various digital assets and tokens. Please check them out. Where can people learn more about Cream?
So cream.finance is where we have a landing page mainly, but we do disseminate most of our news out on our Twitter. So cream.finance. And then we also have a fairly active Discord. You can join through either of those places. You can find how to get into to our Discord. But I definitely think, though, that if there's only one thing you're going to do to research Cream, I highly encourage you to go to our Twitter and look at the pinned message, which is the video of Method Man rapping about Cream. You should check that out. That song will get you hyped, man. Like seriously, go listen to it.
All day. I love that, Jim. Yeah, so we chatted about decentralization. We chatted about Cream Finance and all the products and solutions they're providing to their user base. Not only that, their ecosystem of partners, what they're tackling. We discussed the various blockchains that Cream's actually developing on, the pros and cons and the reasons, and everybody should check out all of these chains in general to learn more. If you're curious and you're interested, a good place to start. So aside from that, we'll go ahead and wrap this up. Leo, we hope to have you back. And again, we thank you for participating at the Reimagine 2021 conference.
Thanks for having me.
All right. Have a good one. Have a good evening.
Yep. Thank you. Hey, have a safe trip out there in Miami. Stay safe and yeah, like hopefully numbers go up from here.